Hey, Steve Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you get sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. I want to touch this week on the most important news of the week, which is the U.S. Federal Reserve raising interest rates 75 basis points. Again, the U.S. Federal Reserve basically runs global monetary, given that they are the world's global reserve currency. So that has major implications on the Canadian economy and particularly the Canadian housing market, given that it is the most rate sensitive portion of this economy. So we're going to get into all of that, but I think first and foremost we really have to talk again about Jay Powell, because what I did as I went through his press conference, I actually clipped out some of the most interesting things that I found in those snippets. So let's clip to those right now.
What we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
What is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve.
At the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country, where famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place.
So basically what Jay Powell is saying, listen, we need to endure pain. There needs to be pain, and the sacrificial lamb is you. It is the lower middle class. He says you need to lose your job in order to get inflation down. We need you to stop asking for higher wages to offset the cost of living, and we need people to be the sacrificial lamb. We need jobs to be lost in order to kill the economy, to kill demand, to bring inflation down. That is the cost. We need you to become unemployed. So more or less, that's essentially what he said. I think I found some interesting comments there on the housing market as well. That the housing market basically needs to go through this reset. Prices need to come down. I think we can all agree that there needs to be some moderation in prices, but prices are already coming down. And once they start coming down, it's a hard train to stop, because it becomes psychological. It becomes a sentiment-based market, which again we're going to get into very shortly. But this brings me to my point that you guys will remember at the onset of this channel, I was very much one of the early people talking about inflation, suggesting this was out of the bottle, that housing wasn't transitory, that these guys should have been beginning to hike their interest rates during the midst of this boom. Of course, we know that, for example, the Bank of Canada started their first rate hike 1 month after the housing market peaked officially in March of 2022. And I'm telling you today, my view is that this is a gross over-tightening of monetary policy. I think that the collateral damage is going to be significant. Everybody, I think it's funny, is I remember getting comments on this channel when I was an inflation-based person and talking about inflation, that I was going to get out of control. And I actually literally would have comments in here, and I would have people emailing me being like, "You're an idiot. It's a deflationary environment. Go watch Jeff Snyder." And Jeff Snyder's a really smart guy, but I just said, listen, I don't necessarily agree. And now I'm getting the same comments of, hey, listen, inflation's out of control. They need to keep going. This is Paul Volcker 2.0. This is the 1980s. Let me just point you to this chart here. This is just of the U.S. It shows here that in the 1980s when Paul Volcker was around, U.S. debt to GDP was around 160%. That's all debt combined. You're now over around 360% debt to GDP. This is not the 1980s. You cannot tell me today that there is just this obscene amount of demand in the economy, that there's just so much demand out there, that this is a demand pull situation. What we had was a currency debasement. We flooded the environment. We flooded the market with too much fiat dollars that debase things, and we were obviously getting through and reworking global supply chains as we shut down. You mandated to shut down a global economy. So again, not only is the U.S. indebted, but the global debt to GDP is at 365% debt to GDP. And as you get this rising U.S. dollar, it's going to start breaking things. These emerging markets, etc. We already know the crisis that's unfolding in Europe. So I think this is unfortunately going to end poorly. But again, these central banks are not leading indicators. If they were leading indicators, they would have been tightening rates well before the start of 2022. And so I think it's going to be the same thing on the tightening cycle. And again, all you can really do is just position yourself accordingly. And, there were some great comments here, which I'll direct you to from Wharton School here, post Jay Powell. So let's clip that in because I think it really summarized just a lot of my thoughts as well.
Money supply data, which is going to show the greatest decline in 5 months that we've had in the post-war period. If he looks at any of the monetary or financial indicators, he can't say, we have to keep them on. At his press conference, he said, we have to get real rates in the positive territory. They're in positive territory for every maturity. For the first time in years, we're already there. I thought that was the most uninformative. And no one was asking him a hard question. How do we have 3.2 million new workers and GDP going down? What does that mean? What does the record decline in the money supply mean? What does the collapse in commodity prices mean? What is the lag construction of these housing indicators that are 40% of the core inflation, which are going to filter through inflation for the next 12 to 15 months? Is that what he's looking at? Why is he looking at that? That's not an accurate view of what housing inflation is. There were no hard questions. There were 50 reporters there. I don't know. They basically said, repeat the statement you made at the beginning. There's so many things I ask him. What is he actually looking at? He's looking at 3-month annualized core inflation that is a lag. Well, we all look at market. Look at what does the stock market do? It looks at market-oriented data. And that's what
Professor,
the Fed should be looking at.
I don't know that I've seen you this animated. You seem downright
I am very
angry
upset. Yes, I am. I'm afraid it's like a pendulum. They were way too easy, as I've told you and many others through 2020, 2021. And now, oh my God, we're going to be real tough guys until we crush the economy. That is just, to me, absolutely poor monetary policy would be an understatement.
Again, you can agree or disagree, but I think he brings up some great points, which is the market is telling us something else. The market is telling us the fact that the Fed is looking at this lagging data. And again, what I would like to point you to next is literally what's happening as we're starting to see flow through the data in Canada, right? We had, as we talked about, hey, listen, inflation is peaked. It's going to peak. It's going to slowly roll over. It's not going to get down to 2% right away. But we are on the path there. These interest rates are going to crush the economy. And so you had Canada's CPI inflation on a year-over-year basis come in at 7%. That's below the expectations for the month of August, which was 7.3. Core inflation also decreased on a month-over-month basis. So core inflation now rolling over as well. Car sales in Canada for the month of August coming into their lowest levels since 1999. Yes, I understand that there's still issues getting cars, but U.S. car prices on the used resale market are now declined for the 3 consecutive months in a row. So if there truly was a supply issue, which there is, you would still expect used car prices to be going up. But the fact that they're coming down and Canadian new auto sales at their lowest level since 1999 is not only a factor of yes, there's supply chain issues, but clearly demand is getting shot in the head, because when your cost of financing a vehicle more than doubles, same as your mortgage rate more than doubling, the demand weakens materially. And so you have that. If you look at retail sales for the month of July, again, this is the month of July, which the data just came out, retail sales down 2% on a month-over-month basis, the first decline since the onset of the pandemic. Not only that, but if you strip out ex-auto sales, retail sales were actually down 3% on a month-over-month basis. So a huge miss on retail sales, which ultimately suggests that, again, high rates on a massively levered economy is going to slow things much, much faster. So for all intents and purposes, these rate hikes are doing what they're supposed to do, which is basically kill demand, bring the economy down with it, and bring inflation down in the process. I just think that what's going to happen is these guys are going to be too slow to pivot, and I think there's going to be quite a bit of pain to come. And so this is ultimately going to, I think right now we're starting to see that again in the housing market. You know, we talk about this moderation in the housing market. What we can see is the gap right now, I can tell you feet on the ground, the gap between what sellers are willing to sell their house for and what buyers are willing to pay is massive. It continues to widen. It actually wasn't that wide during the summer months, even though we had a pretty deep correction in prices. What I'm finding now is sellers are now trying to dig their heels in and push back on some of these prices and push back on some of these lowball offers, and buyers are still seeing these rate increases coming through and actually wanting lower prices. So I can tell you right now the gap is getting really wide, and it's becoming a very, very illiquid housing market. Inventory is still not great. We're still dealing with low inventory, but there is a real struggle. And so I think this is going to be a slow grind lower. But just the fact of not having real estate transactions turning over has so many knock-on effects, right? Moving companies, real estate lawyers, mortgage brokers, furniture stores, renovation companies, etc. And there's no turnover, there's no churn, there's no liquidity in the market. That is going to ripple through the rest of the economy. So again, I always try to look at things more so with housing first, because that's what I understand the most. And when housing is, I think, basically one of the largest components of the economy, they always say that housing tends to be the leading indicator for the rest of the economy to follow. I tend to feel that I have a decent sense of, I think, where things are going. Again, could always be wrong, but I think that the housing market continues to be extremely weak. A couple things to note on the mortgage update side. So mortgage rates remain relatively unchanged. We get some words this week that some of the big banks are raising their 5-year fix by about 5 basis points. So really not a whole lot of change there, but the mortgage rates remain punitively high, north of 5%. Stress testing in the 7s, and so what we're actually getting word from my good buddy Rob McClister, who runs, of course, and founded RateSpy, one of the largest mortgage sites in Canada, and of course confirmed as well through Ron Butler, one of the largest broker channels in Canada through Butler Mortgages, is that OSFI is actively in discussions about potentially removing or easing the stress test. Of course, they update the stress test every December. So again, keep in mind these are just ongoing discussions. Nothing is confirmed. Just because they remove the stress test, it doesn't mean there's a bottom in housing, but it would certainly help ease, I think, the ails of the housing market. So that is actively being looked at. There's also been discussions with the Department of Finance about allowing people to re-amortize. So you guys have heard me talking about the issues on these fixed payment variable mortgages, where if you stop, if that mortgage basically morphs into an interest-only mortgage, and very little is being paid towards principal, suddenly you have this balloon payment upon renewal 5 years later because you haven't paid any principal. So what they're saying is they're proposing a possibility that they automatically allow people to re-amortize, to extend the amortization on renewal only, and you wouldn't not have to re-qualify, because the re-qualifying part is the big issue, I think, for a lot of borrowers down the road, assuming rates stay in these levels. So again, this is still, just keep in mind this is only in discussion. This is not confirmed in terms of like this is a guaranteed policy coming in. But I mean, let's be honest, if the housing market deepens, if the correction continues to deepen, the probabilities of these policies becoming a realistic implementation is, basically increases. I mean, and that's not a right or wrong thing. It's just what policymakers do. I mean, let's keep in mind that the Canadian government right now, I mean, and all provincial level governments are basically fighting inflation by sending out checks in the mail. So policymakers don't necessarily do the right thing. They just do, I guess, what they feel is politically palpable at the time. So, and politically palpable of having mass foreclosures and people losing jobs, etc., is not necessarily politically palpable. But I think regardless, the message I can give you this week is that we are going through turbulent times. I think the Fed is going to overstep and over tighten in the process. I think the data is going to weaken materially, and we talked a lot about this on the Loonie Hour this week. So that's kind of my thoughts, and that basically will translate into the housing market as the Fed and as the U.S. dollar wrecking ball continues to wreak havoc across all sorts of markets, and the housing market in Canada is front and center of that. So hope that helped, and we'll see you next week.